the Wednesday morning market report. I'm Greg McKenna and I'm coming to you from an office in Sydney. It's very bright in here and a lot of white, I'm guessing, on the screen, so I do apologise for that. For the second day in a row, we got confirmation that traders are really nervous about what's going on in global markets at the moment. Europe was down 1%, and while the moves in the S&P and the Dow were nowhere near as negative, falls of 0.3 or 1/4% for the two big indexes, you really get a sense that markets know that the sweet spot in the global and US economy is well behind us, and that the promise of QE in Europe, rate cuts in China, and the potential change in the Fed's rhetoric are being viewed as catch-up plays, not necessarily as positives. It's a real different feel to the market at this next round. I think people recognise that QE, interest rates, those kind of things, the marginal return, if I could put it that way, has diminished somewhat, or to put it a different way, the traction that central banks will get for the incremental easings, whether it's interest rates in China, potentially Australia, although I doubt that, or whether it's QE in Europe or no rate hikes in the US, that traction is not as great as it was previously. So from my point of view, I would say that this is quite a precarious situation for markets. Already we saw oil fall again. It's broken the bottom of its trading range for September, as I pointed out yesterday, and it looks ominous. So it was down again. Now, of course, it rallied off the lows. Markets don't always go one way, but the reality is that oil's under pressure because growth's under pressure. And of course, the news from the debt ceiling yesterday that they're going to sell oil from the SPR has a negative impact on oil. They're not going to sell it this month. They're not going to sell it next month. Yet the first two contracts have both sold off, as has the curve. Likewise, the Aussie dollar has fallen. It fell to a low of just above 71.80. That's around the low of the last 10 days. If that was to break, we'd get a cascade lower. But for the moment, it's holding in. Of course, we've got CPI in Australia today, and there could be an element of markets factoring in low inflation. The market's currently looking for 0.7. And if inflation did fall too far, then people talk about an RBA rate cut and that sort of thing. So if you get a 0.8 or a 0.9 on headline, you might see the Aussie rally. But I think that the Aussie's move is symptomatic of a changed view with traders and fund managers and those sorts of things. Likewise, if you look at what's happened to US bonds, sure, they're up from the lows last week or the week before. But you're down at 203, 204. They haven't bounced all the way back in the manner that some of the other markets have, like stocks. So you're getting a bit of a dichotomy here between stock traders and the rest of the market. Last night the CRB index was lower by about 0.5%. Gold's at about 1166. So it's very interesting. I wanted to focus today on the data in the US. Have a look at my 20 seconds report on at Business Insider. But if you look at durable goods, they fell in September, and August was revised lower. That's not a good sign. Nor is the fact that the services sector, the market services sector print of 54.4 is the lowest in 9 months. Now, don't get me wrong, 54.4 is still a fantastic number and something that most manufacturing sectors around the world would kill for. But the reality is it is slowing. And that's a theme that picked up, and I'm not sure if it's been published yet. Let me just have a look. But that's a theme that's been picked up by the ANZ, who, and so I'll show you the chart. Basically, the ANZ have released a, where am I? Here I am. Released a paper this morning which has a chart, which I'll blow up now. What we've got is we've got US financial conditions. So financial conditions aren't just interest rates. Financial conditions are made up of a number of things, including the currency. Now, remember, I said it yesterday and we've talked about it in the past. Janet Yellen said expressly that one of the reasons she didn't tighten, or not just her, but the FOMC, did not tighten back in September was that the US dollar had gotten stronger. Now, if you have a look at this chart, what the ANZ said, and you can read the full piece at Business Insider, is that financial conditions in the last 18 months have tightened faster than anything since the GFC. Tighter financial conditions mean a weaker GDP, as you can see here, and so we're starting to see that in the stats. We're starting to see a slowing in the US economy. So the Fed, as I think I've said, they've missed their sweet spot. On the one hand, I don't think that the Fed, that zero interest rates are compatible with where the US growth profile is. But one of the reasons I wanted the Fed to raise, and I would have raised earlier if I had been at the central bank, was because they can't cut from zero. Now, of course they can. You know, Europe's talking about negative rates, and of course German 2 years are, negative 30 basis points or something like that. But it's a very different kind of behavioural or psychological impact on an economy to be cutting from zero or throwing cash at something than it is to say, right, we can drop rates from 2 to 1.5 or to 1 or to 0.5% as the RBA could if the market needed it. So have a look at that that piece. It's an interesting piece, and one of the things, it was a piece written by Richard Yetzinger, and one of the things that Richard wrote is that even if the markets do get a sugar hit from what the Fed is doing, or its change of rhetoric, which is possible tonight, that does not necessarily mean that it's sustainable. Speaking of which, if we just have a look, and I know I'm not looking at the camera, so please excuse me. If we have a look at the S&P, last night, we're still holding above the 200-day moving average, which is really important. This is the zone of support. Notice my fast moving average is bolting higher. So you've got about a 30-point range here of support. If it was to get through there, my personal view, from a purely this is the way Greg trades point of view, is I'm happy to be short. At least for a run down to 2030 or something like that, and then I'll reevaluate. But yeah, I'm happy to be short on that one at the moment. While I've got the charts up, if we would just quickly have a look at oil, it's broken down, long tail. Could that be it? Yeah, maybe, but I'm not sure. Not necessarily convinced that that's it for this run. I do think that a run towards 40 is in the cards. That's a bad way to put it. That makes trading sound like tarot reading, but you know what I mean. In terms of the Aussie market, let's go there. Right. So we're still above the breakout range, but this level at 5312, remembering this is cash plus futures, 5312 is the number. The NAB's already missed today, so that's going to put a weight on stocks. Their cash profit was lower than expected, a few other things. They'll be a bit of a disappointment. They could get sold down today. They're a big weight in the index. They could weigh. Likewise, the fall in oil and the energy complex last night could weigh. But 5312 in MT4 terms is the level to watch here on the local ASX 200. In terms of the Aussie, you can see there's a little wedge forming here. We've got a top there, and we've got let's just put a bottom across here. Oops, the bottom. Excuse me, one sec. Sorry about that. Yeah, we've got a bottom here. So, you've got a nice little. Oops. Sorry. you've got a nice little wedge pattern there. 71.80 I think is the key level for me. That's the one I'll be watching during the day for today's trade. What's out tonight? Obviously the FOMC at 2 o'clock New York, 5 a.m. Sydney. That's going to be important. We've got GfK consumer confidence in Germany, CPI here in Australia at 11:30, retail trade in Japan, and of course the EIA storage numbers in the States are going to be really important for oil traders. Craig James, CommSec's chief economist, reported this morning something I didn't realise. Stockpiles are 100 million barrels bigger now than they were last year. So you can see why oil's down. Anyway, it's an interesting day. Keep an eye on those trend lines. They're still working. We'll see what the Fed does. If we do get a change in rhetoric and a bounce, my personal view is it's a bounce to fade. But where you fade it from, where I fade it from, will depend on how big the bounce is and the price action and all that kind of stuff. If, in the worst possible scenario, the Fed holds true to their intention to tighten in 2015, or at least implies that, then it could be one heck of a night for selling stocks. Anyway, we'll see, and we'll see what happens in Asia today. So have a good day. I'm Greg McKenna. You can catch me at Twitter, which is at Gregory McKenna. You can always catch me at Business Insider. You can catch me at my own website, gregmckenna.com.au. If you haven't joined my Traders Club, please join. You'll get a free copy of my Jesse Livermore ebook, just sharing the wisdom that he had as a trader and some of the stuff I learned. I know the dude went broke a couple of times, but he always came back. That's one of the struggles of being a trader sometimes, is that self-discipline not to bet the farm or not to take a break when sometimes you are having a bad trot. If you believe in your system, I guess you trade it. And Livermore just happened to blow himself up a couple of times. But in general, the principles, and everybody's got to fit their own trading system to themselves. The principles that Livermore espoused have worked for me more so than I realised for the last 25 years or so. So you can sign up for that. Also, if you like these videos, please give me a thumbs up or a little note, and also subscribe to my YouTube channel. Although you will get them as a result of subscribing to my my website. Anyway, have a great day. That's it from me. I'll be back Thursday morning, where I'll be coming to you from the Mary MacKillop over in North Sydney. Have a great day and good trading. Bye for now.